Cathie Wood and ARK have had a tough year so far in 2021. After a meteoric rise in 2020, ARK have lagged the rest of the market and their main ETF is down nearly 10% for the year so far. When stocks are going down, this is usually when people sell. Upon reflection though, these times are usually the best to be buying as the stock market is offering you a discount. So is that the case today with Cathie Wood's ARK, or will it continue falling further? In this video, we explore this question by hearing Cathie's thoughts on the market today, how she thinks the latest fiscal and monetary policies will impact the stock market going forwards, how she predicted this dip many months ago, and why she believes innovation is today sitting on a launch pad. So I'm not going to make you wait. Instead, let's just jump straight into this first clip with Cathie.
So Cathie, what I like about you is your consistency, and we have been talking about these themes, right, for a long time. Having said that, you know your performance has been really consistent. It's been a tougher year this year, and you've had flows out of your funds. I was tracking just, I think, over the last week, it's almost $1 billion. So, you know, how do you keep your investors kind of energized in your philosophy and your thinking and your outlook and confident in your strategy, you know, in a moment where there's a lot of doubt out there?
Yes, well, a couple of things just in terms of flows. In our biggest outflows were in March. There are a lot of commentators out there, shall I say, screaming about how ETFs would have to, or our ETFs would have to shut down, which is impossible, and they just don't understand the ETF infrastructure surrounding us. It's a beautiful thing, let me tell you. The flows are no problem. Our spreads have not moved. But anyway, beyond that, what has happened is our price targets for the next 5 years, that's our investment time horizon, have not changed, right?
Not at all. Yeah.
In fact, some of them have gone up as quarterly results have come out. Now, they're not going to change that much because that one quarter's result is not going to change a 5-year price target by that much. But the forces that the put in motion, supporting all of the innovation that in which we invest, they are not looking back. And so what we are seeing is, you know, a 30 to 40% discount to peak prices in February for the same price targets. So we're looking at this saying, all right, on sale, innovation is on sale. And oh, by the way, the bull market has broadened out. It is now embracing value and more cyclical stocks. So what has happened is the bull market has broadened, has strengthened, and that is usually a launching pad for our next move up. This happened, if I can just say, 2016, same thing. Fourth quarter of 16, after Trump, against all expectations, was elected, value stocks took off because we were going to have a big cycle of tax cuts, right? And our strategy went down. We were negative. But what happened was 2017 was one of our best years ever, save last year. And that's because the bull market had broadened out, included value, cyclicals were taking off, and the economy was on the mend. Our economy is very strong right now, and cyclical earnings growth and revenue growth is a competition to innovation. But if we're right on what's happening with commodity prices right now, and that's going to be extended, that is the ticket to the next move in our kinds of stocks.
Well, it's interesting too. What about though the tech underperformance, Cathie, that we've seen? How much longer do you think, you know, we see that?
Well, you can never say when we've hit bottom. I mean, I can tell you that the valuations in our portfolios would suggest that over the next 5 years, again, if our research is correct, no promises. We believe that our portfolios will more than triple over the next 5 years. So that's more than a 25% compound annual rate of return over the next 5 years. Actually, it's approaching 30 after today. So, I'm looking at that with great confidence because these innovation platforms have hit escape velocity. We're not going back to the old world. We're not going back to the old world. So, my confidence has only increased in our strategies.
Now, when you listen to Cathie, one thing is clear. She is consistent. Whether her portfolio of stocks is performing well or performing badly, she isn't bothered because she is laser focused on her 5-year time horizon. Now, as an investor, I love this because one of the most common mistakes of investing is to get overly emotional and make short-term decisions that deviate away from your long-term plan. Cathie, however, remains committed to the long term. Now, because Cathie's 5-year price targets haven't changed, from her perspective, all that really means is that the opportunity today is greater than ever. Instead of aiming for a 15% plus year-on-year growth rate, Cathie is now targeting 25% plus. And this commitment to her principles has been shown in her recent actions. I'll explain what I mean by this in just a second, but first, a short clip for context.
Can I ask you, why did you guys get out of Apple?
So Apple was one of our cash-like instruments. It's an innovative company. It's in the innovation zone, but its characteristics are very defensive. So we will add names like Apple, the FANGs, Apple, Google, Facebook. We will add to those positions or even reintroduce those stocks. As a bull market, our portfolios were up 150%. We knew there was going to be a correction, and we just wanted to have very liquid stocks. Apple is a great company. It's going to do fine. It's a FANG. It's in a lot of portfolios. We are all about the next FANGs, but we will use the existing FANGs. If you see, they are acting very defensively. Become a defensive group. So we will fold them in, increase them when we see a move like we saw last year. When we see a decline, like the one we're seeing now, we're seeing much higher returns from the other stocks in our portfolio.
So if you've been following Cathie closely, you'll know that over the course of this year, she's regularly been talking about how innovation stocks have grown too quickly and a pullback was always due. In fact, she's not just been talking about this, she's been taking action. You see, because ARK are an ETF, there are strict regulations about how much cash they are allowed to hold. If a normal investor, like you or me, if we think the market is going to pull back, we might begin to build up our cash position. However, because Cathie can't hold much cash, instead she buys stock positions in the largest tech companies, such as Apple, Google, Facebook, etc. Now, she describes these as her cash-like investments. Now, when a dip does come, these stocks, they might drop, but they won't fall by as much as the less established innovation stocks. At this point, she'll sell the larger names and begin to move back into her higher conviction investments. So basically, to cut a long story short, when Cathie and ARK are selling the safe stocks, the larger stocks, this is when they believe an opportunity is presenting itself. Well, we've already heard how they've sold all of their shares in Apple. Here, we can see how they've cut down their position in another established company, Regeneron. And we can see the same pattern with Facebook too. Now, when we look into their higher conviction names, such as Teladoc Health and Palantir, we can clearly see the pattern. Cathie and ARK have been moving their money from the safe investments to their higher conviction names. This is the clearest signal that Cathie believes this dip is simply a short-term buying opportunity. Of course, we've already heard her saying it, but this is the proof that her actions also back up her words. Now let's hear Cathie's thoughts on some of the more macro forces in the stock market today.
And it does seem like the tax talk is now more around corporate taxes, but not corporate taxes going up, tax rates going up from 21 to 28%, but now this minimum corporate tax at 15%. So every corporation who has not been paying taxes pays at least 15%. That seems to be the direction in collaboration with the European Union or the G7, I believe. So that's very interesting. This means we may not see a capital gains tax rate increase, which would be phenomenal. And I do believe the market is starting to respond to this, nor a corporate tax rate increase, certainly not to 28%, maybe a few percentage points, but even that seems to be diminishing in probability. So I would say on the fiscal policy side of the equation, relative to our fears, certainly, about capital unfriendly policies, and certainly policies unfriendly to innovation, we are beginning to feel a lot better. Now, the monetary policy side is also very interesting. The Fed, despite what everyone seems to be saying, the Fed is already starting to react. Interestingly, the money growth rate, so M2's growth, peaked in February at 27% and is now down to 18% on a year-over-year basis. I haven't seen it below the 20% range in more than a year, I think, or roughly a year. So that's very interesting. Anyone worrying about inflation will have to take note of that. 18% is still a very rapid rate of growth, but the direction has changed unequivocally. The other thing that happened this week is the Fed said it was going to unwind some of the bond ETF and outright bond purchases that it made during the depths of the coronavirus crisis. Now, this is only $60 billion, which is nothing when M2 is at roughly $20 trillion and the monetary base close to $8 trillion. But nonetheless, it's a change in tone. Again, those worried about inflation have to take note. The Treasury bond yield has dropped from 1.75%. This is the 10-year Treasury bond. So 1.75% to 1.55%. And today we got the wages higher than expected. We've seen inflation indicators higher than expected, as I just mentioned, and yet the bond yield is going down. This reminds me a lot of 2006. The bond market got that one right as well. Energy prices soared from 2006, I think they were at $60, all the way to $140 in the spring of 2008, even though the writing about housing was on the wall. Maybe it wasn't on the wall in 2006, but that's when the bond market began to see it. So we believe that the bond market is recognizing here that inflation is not a problem, and that growth may slow down, especially on the good side of the equation. So I think we're going to see quite a bit of drama during the next year.
So Cathie notes a few things which have swung in favour of the stock market recently. First off, it's looking more and more likely that there won't be an increase in capital gains tax, or if there is, it will be less than previously proposed. The same goes for a potential increase in corporation tax too. Now, a rise in either of these obviously would have been negative for the stock market, so this change in likelihood is a positive. On the monetary policy side, it looks like the Fed could be beginning to calm down a little bit. In February, the growth of the money supply peaked at 27% year on year. Now it is down to 18%, falling below 20% for the first time in a year. Now, clearly an 18% growth year on year is still pretty crazy, and nobody is suggesting otherwise. I believe Cathie is just trying to make the point that this is the first time in over a year that the Fed are at least beginning to show signs that they are calming things down a bit. Another important point relates to inflation, and this is something we've been talking about a lot recently because it is so important. As inflation fears rise, the stock market is going to suffer. Cathie, however, has not been fearful as others about inflation. And one reason for this is because she believes there will be a transition of how people choose to spend their money. You see, over the past year and a half, people have been buying more and more goods. After all, we've been stuck inside for large chunks of time, and most services have virtually been closed down. So in turn, this has caused a growth in the value of goods. Now, however, as we begin to return to some level of normality, spending habits are beginning to shift away from goods and flow towards services. The overall result could mean a much needed deflation in goods. It could also mean an inflation in the price of services. But with so many services being in difficult situations at the moment, this is necessary and will ultimately result in a positive for the economy. So those are Cathie's thoughts on inflation, on taxes, on the stock market. Plus we've seen that her actions are backing up her words. But I'm interested to know, what do you think? Do you think this is just a dip for Cathie and ARK? Let me know your thoughts in the comments below. Thank you for watching. I will see you again very soon.